home builder sentiment is not good. It's just not good at all.
Gentlemen, I can't remember. You can tell me if it's been 2 years or 3 years since the housing market started being such a drag on the economy. But Joe, you were saying that at least there are some glimmers of hope on the horizon.
Well, maybe things have gotten dark enough that it's just before the dawn. Being an investor is a funny thing. You have to swim against. You got to swim upstream. You got to go against the crowd. That's the only way you're going to be a good investor. If you just do what everybody else is doing, you're going to get the same results as everybody else. So if you're trying to do something and get a better result, well, you're going to have to do something different. Well, everybody hates housing. Home builder stocks are not liked. Everybody knows that the housing market is a mess. Sales are not, sales are down, housing starts are down, permits are down. All these things are negative, and they're all already known. And they've been that way for a while now. It's been a couple of years, 2 or 3 years, where housing has been a drag on the economy. And it actually goes back a little further than that, Bob, because the addition to the economy really comes from new homes and building new homes, not from existing home sales. And a lot of the activity that happened during COVID was existing homes. And so that really didn't do much for the economy. So anyway, I got to thinking about this recently. I watched Lennar. Lennar is one of the bigger home builders in Florida company, which I know pretty well. And so they had an earnings report recently, and their earnings were less than expected. Still very profitable, by the way, but their earnings were less than expected. They missed by about a nickel, but their revenue was better than expected, and I think more importantly, the orders year over year were up about 6%. The stock was down like 4.5% the day after the earnings came out after the close, and the next day the market opened, stock went down like 4.5%. But that was about a month ago, and it's already back above where it was pre-earnings. It did not make a new low either. The low set in April, it held well above that. So I thought, technically it looked pretty good. And the bottom line is that what we're looking for is positive action in the stock or in a sector when you've got bad news. It just means that all the bad news is kind of in the price. I don't know if we're quite there yet, but I think we're getting close. Start thinking about interest rates, and if you get mortgage rates to come down some, I think you could see a pretty good pop in home sales, and that would have a knock-on effect in a whole bunch of other sectors too, by the way. So it's kind of interesting. We've seen interest rates have come down over the last month. Actually, not even a full month, really. 30 basis points since May. Gosh, well, I think it was May 22nd. That May 22nd. That since then rates are down about 30 basis points on the 10 year. So uh, I don't. We don't want rates to go down a whole bunch because that would mean the economy's terrible. But if they come down some, that could be pretty good.
Steve, that goes right along with what we do at Alhambra. If everybody's going in the same direction, we want to go the other way. So, sounds like a positive that we're looking at something that nobody else is really paying attention to yet.
Yeah, and not to overstate it, but that everyone is an important point. Sentiment doesn't often tell you too much because a lot of times it's pretty mixed.
Yeah.
But when it gets extreme, when you have everybody who could sell has sold, or everybody who could potentially buy has bought, I'm exaggerating a little bit, but not too much. You do get some points where it gets fairly extreme, and those are about the best market indicators you're going to get. Yeah, things that are bad could always get a bit worse, and things that are good can always get a bit better. But man, if I had to pick one indicator, it would be extreme sentiment. And as we were talking, I just Googled housing, and on Google News, these are the three top headlines I got. U.S. housing market clouded with uncertainty, new study shows. Housing market at risk of sustained downturn as price growth cools. Doge layoffs are starting to leave their mark on DC's housing market. And I'll tell you, that's not atypical. I have a pretty good feel for the pulse on this sector, and it's uniformly negative. I mean, it really is pretty bad. So you do have what you need for the makings of a bottom here. I would also add stocks move on what hasn't happened yet. They are always kind of pricing in their expectations of the future, maybe by as little as 3 to 6 months, but often by 12 to 18 months. So you actually don't even need things to be getting that much better. You just need some leading indicators showing that, and the stocks will move on it. So I think there's a lot of reasons to kind of back up Joe's thesis here. I would also add on his point about home builders, new homes versus existing home stock. The home builders have been doing a better job of managing this, in terms of doing discounts, in terms of reducing the footprint, in terms of doing more concentrated builds. They've been doing things to manage this and to adapt to the environment. We may not see us going back to what housing used to be in terms of the amount of square foot you got, or the backyards you got, or whatnot. But that doesn't really matter for the builders. What matters for the builders is, are they able to make profits or growing profits in that? And I'd say the outlook there is more positive than what the typical observer is looking at. They've adapted to this environment, and I totally agree that you've got fairly extreme sentiment here. And if you doubt us, just go on Google and pop the headlines and see what pops up.
Joe, do we have to watch this one particular company a little more, or do we need to see it more broad-based before we really take some action?
No, listen. I actually think if you just look at stock charts and just look at the stock charts of all the home builders, they all look pretty much the same. So I think we're getting similar action on all of them. I haven't looked at all the earnings yet. Listen, everybody should know that when we talk about stuff on here, we're just kind of thinking out loud. This doesn't mean that we're lining up to buy these things tomorrow or anything like that. It means we're doing research, and this is what we do. So let's talk about that sentiment for a second. We have this thing called the housing market index, which is essentially home builder sentiment. Yeah, it's at 32 right now. It's not very good, guys. That's one of those diffusion indexes where if it's above 50, it means that things are positive, and if it's below 50, it means things are negative. So we're at 32. So we're not positive, that's for sure. And if you exclude 2008, 2009, that's about as low as it gets. And you really want to be a buyer of home builder stocks when that sentiment number is low. Other than 2008, 2009, the only other reading that's lower was in January of 91. It got to 20. By the way, 2009, I think it may have hit 10. That's how bad it was. That was extreme. But anyway, so home builder sentiment is not good. It's just not good at all. And like I said, that is the time to buy home builder stocks generally, or construction related, however you want to put that. There's a lot of different things there. It's not just the home builders. There's a lot of different other businesses that benefit from more activity in the housing market. Anyway, it is very negative right now. That's the sentiment side. Let's talk about interest rates for a second, though. I think it's interesting on the interest rate side. You guys, I'm sure that, you guys, we talk about credit spreads all the time, right? The difference between a treasury note yield and, say, a junk bond. Well, we also look at mortgage spreads. What we do is we compare the 30-year mortgage rate to the 10-year treasury rate. And that has a long-term average. The spread is about 1.75%. Well, right, it's been elevated for quite a while, and it is now still at 2.43. And so the question is why? Well, the why is pretty easy, actually, because it's really directly related to the Fed's quantitative tightening. The Fed is allowing the mortgage-backed securities on its balance sheet to mature or to roll off. And actually, the way it works is that, you get monthly payments on these mortgages, it pays down the balance, right? So they've rolled off about 600 billion, 5 to 600 billion since they started doing this, since they started quantitative tightening. So it sounds like a big number, but we've still got, I think, a couple of $1 trillion worth of these things sitting on the balance sheet. But the problem with it doesn't roll off very quickly because you're not getting a lot of refinances right now. Those would pay off those mortgages that are existing and do new mortgages, and the Fed's not buying mortgage-backed securities. So anyway, the point is that's one of the reasons why this spread is wide, is because the Fed essentially has been a seller. Actually, it's more like they haven't been a buyer, because remember, they bought these things during QE. But it's interesting because they have slowed slowed the roll off of treasuries, and this could affect the demand for and supply of mortgage-backed securities. in March they announced starting in April they cut the roll off of treasuries down to 5 billion a month, and it'll eventually go to zero. So if those treasuries, that's essentially supply, because if they don't renew those things, then the market has to absorb more treasuries. Well, if they stop that roll off, then that's going to affect supply of treasuries. And if it affects the supply of treasuries, it may affect the demand in the mortgage-backed security market. So there's a lot of moving parts there. But the bottom line is that you could bring mortgage rates down, close to 0.75% if you just close the spread to the average. And so that we could see mortgage rates come down, is my point. That would certainly have a positive effect on housing. And we saw that back in September, August and September, when rates went under 4%, the 10-year went under 4, mortgage rates came down. You guys remember that? We got rates down close to 6%, and you got a pop in housing activity. If you get something a little more sustained, you could get some real pickup in activity there. Now, just be careful what we wish for. We don't want rates to go too low, because that would be an indication that the economy is in trouble. We've seen some slowing in the economy. Rates have come down some. That's good, but we don't want it to go too far. So we're keeping an eye on this. It's something that's on our radar for sure. We love looking at things that everybody hates, and this is certainly fits that description. So we'll keep you guys up to date.
And we are watching. We're doing a lot of research. So if you're having some questions about your portfolio, let's talk about how we can help you.